All right, great. Great. All right, well, let me just get the record up and running. Just give me a second right here. I'm just going to pass the controls to Mark. So, Mark, if you could just bring up your PowerPoint. And let's just do a quick audio check with Mark. Go ahead, Mark. Let's just check your audio really quick.
Hey, how you doing?
All right, good. You sound perfect. All right, let me just do a quick intro and just hit the recorder up and running. So everyone just give me a second here. All right, everybody, welcome back. This is Fausto from Cyber Trading University. This is Closing Bell. Just want to kind of, hopefully everybody's been enjoying the great volatility I've been having in the market. A lot of great stocks been happening in the Cyber Group room, and you can see what's been happening lately with some of the stocks we've been watching. It's been with between oil and an FXCM trade and all that. It's been quite exciting, great volatility, great happening, and there's nothing better than our next guest that we have here on Closing Bell. And basically, it's Mark Sebastian. I'm going to talk a little bit about him, and then I'm going to pass the ball over to him to take over. Really quick, just tell you a little bit about Mark Sebastian. Remember, today we have two events that's going on. Today's Options Day. We have Greg McDermott that's going to be coming on later this afternoon. Now, a lot of you guys know that I am not a huge fan of swing trading. I'm a bigger fan on options trading because I'm not a believer of buying. I'm a believer in leasing. Why go out and as long as you know how to do it right. You know what I mean? And that's why we are very, very big. And you notice options has been very big. It's picking up more and more every day. More people are realizing that there's great opportunities there, and that's why we kind of promote and talk a lot about options trading. But I want to tell you a little bit about Mark Sebastian because the only thing I think that's missing on Mark Sebastian on his resume is he doesn't have a badge with all these awards on it where he looks like a general. But I'll tell you a little bit about Mark Sebastian. He's both former member of both of the Chicago Board of Exchange and the American Stock Exchange. He's also the author of a popular book, Manual, The Option Trader Hedge Fund. He's frequently a guest on CNBC, Fox News, Bloomberg, First Business News. Sebastian has also published random videos on Yahoo Finance. He's been quoted on the Wall Street Journal, Reuters, Bloomberg. He's also an all-star contributor on TheStreet.com, Option Profit Team. Mark has been spoken on the Options Industry Council, the CBOE, the ISE, the CME. Like I told you, everything he's been. I've seen people with a big resume, but the only thing that's missing on him is like the general badge. That will have all these awards on it, where he's been. So obviously you could see he has the experience to be here, and that's why we want him here today, because I know that we do have a lot of options traders, and there's nothing better than to have a guy that does it all day long. And he's, Mark's been a great contributor to the education community, the trading community, and that's why we wanted to have him here again. It's been a while since we had him, but we're happy to have him back. So he's going to tell you a little bit about and educate you guys a little bit more about the options, and then he'll close out the meeting, tell you about a little bit of promo if you guys want to learn a little bit more about it. And then don't forget Greg McDermott, our options instructor that trades on the Philadelphia Exchange, is going to talk a little bit also about options also. So, ladies and gentlemen, enjoy the presentation.
I'm just kidding.
Enjoy the presentation, everybody, and the stage is all yours, Mark.
All right, thanks. No, I'm just kidding. Philly's one of the floors I was not on, and when I was on the Amex, we hated the SIBO and the Philly, and especially the P Coast. Then when I was in SIBO, we hated it, the Amex, the ICE, and especially the P Coast. So it was always funny, So even I haven't been on the floor in 4+ years, and I'm still there's still like a little internal rivalry. I'm sure Greg would feel the same way. So, I want to thank you, Fausto, for having me. It's exciting to be here. Fausto's one of the, he's got everything that I could want in a good-looking Italian guy, which is it goes my mother, and then my aunt, and then Fausto in terms of my three favorite Italians. So that's the way it is. Well, I suppose myself. All right. So let's talk now. Problem, all right? Trading margin stocks is margin intensive, all right? Investing in stocks ties up capital, all right? The market can lead stocks one way or the other. It can be hard to tell which way the stock market is going throughout the day. So what am I going to teach you? I'm going to teach you how options and stock are related, replacing stock in day trading, replacing stock in investing strategies, and an indicator we use to analyze the SPX. And this is actually something that I wrote up for my friend Jim Cramer for tonight's Mad Money, actually. So if you watch Mad Money, I did a VIX analysis for Jim this evening, and you know, I think it'll be pretty good. That's always funny when yeah, I'm just gonna briefly tell you a 20-second Cramer story. It's always funny because it'll be like 5 o'clock on a Friday or 6 o'clock on a Friday, and you're having a beer with, you know, some friends, or you're out with the wife or something, and you get an email in like large, extremely large, bold-faced purple font, and it'll say, "What are you thinking on VIX?" And then, you know, you respond to something, he's like, "Can you write it for Friday?" And it's all in this ginormous, it's the exact font you would imagine he would use. That's what one of the things I think is funny. He emails like he works. So, stocks and options. All right, options are derivative of stocks. All right, this means for an option price to move, generally speaking, the underlying price must move. All right, how well one instrument moves with another is called correlation. All right, correlation in options can be a number between -1 and 1. So an option can never correlate greater than its underlying instrument. You know, there are, you know, in the stock world, we'll look at the beta of a stock and we'll say, well, its beta is 1.5, or which is really correlation. In most cases, the beta is really just correlation. You know, the beta of the stock is 3, the beta of the stock is 6. The beta of the option, the correlation of the option, all right, will never be relative to its underlying stock less than -1 or more than 1. All right, now for options, you know, stock people look at, you know, a stock relative to the index and they call that a beta, right? Well, we look at the option relative to its underlying and we call that correlation delta. Why do we call it delta instead of correlation? It sounds cooler. All right. No, I think it's something that physicists and mathematicians really started the idea of option pricing and risk modeling, and you know, they love pulling Greek letters. So for option traders, how well the option correlates to its underlying is called delta. Thus, options can have a delta between -1 and 1. All right, options that have a positive delta will move with the underlying. Options that have a negative delta will move opposite of its underlying. All right, so if I've got a positive delta, and then when the underlying rallies, I'm happy. When the underlying falls, I'm sad. If I have a negative delta, when the underlying, right, and when I say underlying, everyone knows I mean the stock, right? So you've got Apple options, and then the underlying is Apple, all right? So, you know, if I've got options that have a negative delta, and Apple goes up, I'm sad, and if Apple goes down, I'm happy, all right? And you know, that was actually always the way it was presented to me when I was learning. They would ask you a question, and they said, "Are you happy or sad?" And that was the way you were supposed to try and figure it out. And we would say happy, and then because. So here's an example. All right. So this is in TLT. This was from January, and you can see that, you know, the Jan 123 call, which is in the money at the time, has a delta, it still is, has a delta of about 81. The 129 call at this time had a delta of about 21.80. If you're looking for where the at-the-money option is, where TLT is trading at the time, find the option closest to a 50 delta. That's going to be the closest option to where this thing was trading. So at the time I took this shot, TLT was trading about 126. All right. The TLT Jan 123 calls have a delta of 80. All right, so if TLT moves higher by $1, the 123 contract calls will make $80 per contract, or 80 cents in the options price. If TLT falls, then the option will lose. All right, it will lose $80 or 80 cents in the options price. All right, pretty simple. Pretty simple. All calls have a positive correlation. All right, so now here is puts. All right, here's the TLT Jan 127 put. It's 61. It's a 61 delta. All right. So the Jan TLT 127 puts have a delta of negative 61. Thus, for every dollar the TLT rallies, the Jan 127 puts will lose $61 or 61 cents. For every dollar the TLT falls, the Jan 127 puts will make $61 or $61 in the options price. All puts have a negative correlation in the underlying. So you've got calls that always have a positive correlation. Then you've got puts that always have a negative correlation. Then to figure out whether you're happy or sad, it's whether you bought or sold it. All right. So just because the options price is happy or sad doesn't mean you are happy or sad, right? If I sell a stock and it goes up, even though that stock had a positive correlation to the market, all right, that doesn't mean I'm happy, right? Because I'm short. All right. If I am short a put and the underlying rallies, since it has a negative correlation, so it loses money in a rally, but I'm short it, so a negative times a negative creates what? A positive. Very simple. So, let's go back to this chart. Let's just real quickly do one. All right. So let's say that I own, let's do a simple one. All right. I own the 126 calls, which are essentially a 50 delta. All right. And the underlying rallies, $1. How much will the 126 calls be worth? And yes, I'm aware there's gamma, but for now, let's just ignore that. Bueller. All right, so they're 136. They're a 50 delta. If the underlying rallies 1 point, how much will these be worth? Oh, I can't view question and answer. I don't know if Denise is here or one of the organizers to allow me to see that. All right, well, here we go. I can't see the Q&A for the webinar, so can you, you might have to make me an organizer so I can view that stuff. All right.
Mark, you should be okay right now. Just let us know.
Oh, was I muted? Okay, yeah, somehow I got muted. Okay, cool. All right, can we hear me now? Thank you. All right, so yeah, you buy this 50-cent. You buy this option for 136, and it goes to 186. Obviously, if you're long it, you're happy, and if you're short it, you're sad. Now, where people often get confused is on the short put side. All right. So if I put on the, let's just say the 143 put. All right. If I have the 143 put and the underlying goes up 50 cents, all right, what's the put worth? Yeah, it's going to be worth 50. It's going to be worth 50 cents less. So it's going to be worth 93 cents. Now here's what throws people off. If I owned it, right, I'm happy, or I'm sad. If I'm owned it, I'm sad. But if I was short it, because it's a negative times a negative number, that is money in my account. So that's really understanding how those correlations move with the underlying is just a pretty big deal. All right. All right. So now let's talk about how to replace a stock. All right. The minimum overnight Reg T margin on a stock is 2 to 1. All right. So if I have $500,000 in an account, I can trade up to $1 million in stock on margin, Reg T. All right, that means if I buy 1,000 shares of $100 stock, all right, my margin is 1,000 times 100 times 0.5, all right, or 50,000 bucks. That's a lot of capital tie-up. That's one trade. All right, that is margin intensive. All right. So option replacement. All right. So if you want to replace the stock, one thing you can do is buy what's called a heavy delta. All right. A heavy delta option. Using it, I can replicate the exposure of 1,000 shares of TLT using far less capital. All right. So for instance, if I buy 13 of the TLT Jan 123 calls, I get about 1,000 deltas, that's share equivalents of the stock. But let's compare the cost. All right, so I'm paying about $330. So my stock margin would be 125 times 125.77 times 1,000 times 0.5. My stock margin is $62,885. Interday you can do better, but overnight, all right, and this is actually to Fausto's point he made at the beginning, right? Overnight, 62,000 in equity. I mean, if you're a trader, if you're a day trader or a swing trader, it makes no sense this route. You're just creaming capital. That's your average Joe, that's going to be two, maybe one or two trades. Now let's look at the option margin. All right, the option margin to get the same delta exposure, all right, I'm getting 1,000. My cost, margin equivalent, 4,290 bucks. All right. If my goal is to make $2 on a day or swing trade, I'm trying to make about $2,000. What's the return? Would you rather make 2,000 on 63,000 or 2,000 on 4,300? What do you think? Pretty simple, right? Well, the nice thing is this really allows you to do more trades and better trades. All right. One, you're not tying up all this capital and risking, every time you're in. Two, you do have that capped floor, which is really huge. All right. Well, that's one of the nice things. So in buying those calls, if we wake up tomorrow, and this wouldn't happen, but let's say we wake up tomorrow, the British announce they're not doing QE and the Fed raises rates at the same time. All right. It's not the British, the EU. So what do you think would happen to the 10-year note if the yield on the 10-year note, if on Thursday morning we wake up and there's no QE, and then the Fed ahead of time announced, yeah, we're raising the short-term rate by 25 basis points. What do you think would happen to the 10-year? The 10-year would not be up. The yield would be way up. The bond itself would get destroyed. Or the note, not really a bond. Yeah, I mean, I think on a move like that, we could see a one-day move in the 10-year note from 1.75 where we closed today back up to maybe 2.324. And then really you could get some, like a systematic panic sell, where basically, one of the problems with the way the 10-year note is used, because everybody uses it to hedge interest rate risk. When yields start picking up, all these firms have to buy it, and so it actually creates a mechanical sell-off. All right. So yeah, the 10-year note would go to, I think it could raise 50 basis points in a day. That would put TLT down below 123 like that. I mean, from 126, yeah, I mean, it could have dropped to 119. All right. So now choosing the right option. All right, for stock simulation, the 75 to 80 delta option is typically going to track that stock well enough that one can use it in day trading or swing trading. It also should have enough liquidity that traders are able to get in and out of the option. Once you get into kind of the 90 delta territory, the liquidity rise up. At the 75 delta, you can still get stuff done. All right, and one of the nice things, all right, so if you're going to go long, you can buy calls, or if one is going to go short, you can buy puts. All right, or if you take things to a second level, all right, you can look at volatility. All right, and if you add volatility in, you may decide to go long by selling a 75 delta put or instead of buying a 75 delta call. All right, you may decide to sell a 75 delta call instead of buying a 75 delta put. All right, and that's really once you add volatility in, you can get that. Now, I've got that both this video and the one that really walks through that are going to be posted on a page I'm going to send to you here shortly. All right, so in short, if volatility is normal or low, we buy calls or puts. But if volatility is really high, one can sell a deep put spread or a deep call spread. All right, so basically you sell an 80 delta put or an 80 delta call, and you buy a 5 delta call or put as a hedge to reduce the margin, and you'll do significantly better. Significantly better. All right, so in short, all right, that's the way to do it. All right, so now let's talk long-term investing. All right, in the past we've shown how short puts and covered calls can enhance the income of stock investors. The issue is that the margin associated with owning the stock, shorting a put, is still on Reg T margin, so it can be expensive. All right, rather than executing the covered call, one can execute what's called a diagonal spread. All right, one can buy a long-term put option with a slightly heavy delta. All right, a delta of 50 to 70 in the 50 to 70 delta range. All right. Then sell an out-of-the-money option with a smaller delta in the 20 to 30 range. One can use monthly options or weekly options. All right, it's a great way to do it. So here's an example of one that I did through kind of the middle of January, and it was on my Track the Trade show. All right, so Track the Trade was a short-term diagonal. All right, I bought, and the Apple was up at the time. So at the time, I bought an Apple Jan 110 call for 450. I sold the 114 calls against it in December at 75. The D's calls expired worthless. I then sold the December 26 114 calls at 55. They expired worthless. I then sold the Jan expiring the second 115 call at 70 cents. All right. Then after that, the underlying value fell, and as of the time of this, when I built this, all right, my Jan 115 call that I was short was worth 9 cents, and my 110 call was worth 365. So I'd made a lot of money. I'd done really well on this. All right, and so you can really produce a lot of income against covered calls, and it's in a much cheaper fashion. All right, now one could do a longer term trade. So let me show you this. Thought I had that open. So let's look at Apple, and let's see how we might construct one now. People always seem to like real-life examples. Now they've got earnings coming up. All right, so we do have that to think about. Boy, they really helped the S&P. They basically saved the S&P today. So let's say that I wanted to trade a longer term. Maybe we look at like April. So if you look at April, this isn't bad. I could buy the 105 call for $8.50. So if I buy 10 of them, say I want to simulate owning 1,000 shares of Apple. So I'm putting out 8,500, all right, and I'm buying what amounts to a 60 delta option. All right, then if I want to do this the easy way, I might go into just Feb, and I could sell the, the 110 call at 360. All right, and that would be a very simple way to produce income. Now, if I want to be more nuanced, I can do it as a weekly trade. So what I would do is I'd go into the Jan 23s, and I would maybe sell the 110s, all right, at 75 cents. Then next week, ahead of earnings, I could get, we'll say probably over $2. So let's say $2.50. So that would be $3.25. Obviously, if it blows higher, I've got a problem. But if not, go me. And I could do something further out of the money. I could do, on the Jan 23s, the 110s are a 30 delta. If I wanted to stick to a 20 delta, I would do the 111s at 45. I would do the 115s at 97, so I could be like $6-7 out of the money, and so on. Why am I doing it this way? Well, there's two different, I'm doing it as a way of doing a covered call without actually owning the stock. I'm renting the stock by doing by buying a long-term call. All right, and that's really the value. That's such a great way to produce income. You know, why there's an old saying, why buy the cow when you can drink the milk for free? That is so true in options and in stocks. You should never buy the cow. You should always just drink the milk. And that's what you do with options. Questions on this? Yeah, are you sequentially selling the front week to create calendar spreads? Yeah, you're doing a diagonal calendar. So you're buying it slightly in the money, and you're selling slightly to somewhat out of the money so that you get long exposure, but you're also creating income, just like a covered call. But you're only paying $8,500 to rent it. Yeah, so like the first trade was Jan 110 versus the Dece 114. See? So in this Apple trade, maybe I went a little fast. In Apple, I was looking at buying like the 105s. I could buy the 100s, which are about $4 in the money. And then in Jan, in the one expiring on Friday, which is in 2.5 days, if I wanted to sell around the 20 delta, I would sell the 111s at 45 cents. That's the diagonal. Then earnings week, if I wanted to sell around the 22, 25 delta, I would sell the 114s or the 115s. So I'm creating something that basically has this kind of payout. So go. So if you charted this, this is what it would the risk chart would actually look like. And here's 105 1-to-1. Here's 105. Here's 111. All right, does that make sense how that payout works? All right, what's the best strategy if the price pushes through the early call price? Usually roll out and back, typically. So I'll buy, I will try and buy that at the money and sell something out of the money again and get a credit on it. Get back to my slides. All right, so here was another one in Facebook that I did that was like a Jan Nove. All right, it was I bought the Jan 75 call for 251. I sold the Noves. 75s I had to cover in the money. Then I sold the 77s, and those expired worthless. I sold the Dece again at 80. Then I sold the 19s at 130, covered for 2. You can see different cover prices. So all in all, I made I produced income on something that was really moving around. This was a terrible long-term calendar diagonal candidate. Did not work very well. But I still made money on it, which was a thing of beauty. So when to execute. This is a great strategy in just about any environment. But when IV might be high in the back month, it will typically be higher in the front month. Thus, many vol distortions will quickly be covered. All right. So be watchful if a vol distortion 1 month. So like, don't buy the most expensive month on the board. All right. Pay attention to where all the different months are trading. And I don't mean most expensive in terms of the cost of the option, but I mean most expensive in terms of the volatility you are buying or selling. All right. Other conditions, all right, can be great to buy an earnings month or week and then sell the front month or weekly option in front of the purchase. One of the things that I like about doing that, so like we know Apple, like, you know, a month ago, we knew Apple was going to have earnings the week of the 27th. That is a great option to buy for this diagonal play because it will actually have a slower decay because there will be some embedded risk from, there'll be some embedded risk into the earnings month. All right, so it should be executed when one expects the stock to move slower. So like in Apple, I did a good job. In Facebook, I did not do such a good job of picking, and I still managed to make money. All right, so now let's talk about VIX as a trading indicator. The ES, the S&P 500 future, is really the leader of the market. All right, it leads SPY. The broad market indexes will more or less point to the direction many stocks take in the near term. So, you know, when I was a floor trader and I was debating whether or not to work a stock order against an option trade I just made, you know what I looked at as one of my major things to decide whether or not I should cover right away? What the S&P 500 future was doing. So, you know, if a guy walks in and basically he does a trade that is going to cause market makers to hedge 50,000 shares, all right, the stock is going to move lower by a few ticks. All right. Now, sometimes it was absolutely worth it selling those deltas right away. All right. But, all right, when the ES weakens, all right, most stocks will actually weaken with it. So if let's say I needed to sell 5,000 shares of a stock. If I'm looking and there's a bunch of market makers selling it, but the ES is rallying, I would usually wait. But if I was doing that and the ES was weakening at the same time, I slap my stock right away. All right. Now here's what's kind of neat. There is something that leads the S&P 500. All right. In this scenario of which came first, the chicken or the egg, VIX futures and VXX come first and ES follows. VIX futures / VX and VXX will almost always tick ahead of SPY. And so VIX futures almost always tick ahead of the S&P 500 future, and VXX almost always ticks in front of SPY. Sometimes VXX ticks before VIX futures, sometimes the VIX futures tick before VXX. That's a little tougher to tell. But if you're looking for an indicator as to what the S&P is going to do, watch VIX futures. If those make as much as a 10-cent move in one direction, that can amount to a 2 to 5 point move in the S&P 500. All right. For those looking for enter and exit points, watch the VIX futures along with the S because VX will lead ES. All right, so now here's one where these things start. This is just an example from when was this? Like December 30th. All right, and you can actually see that the VIX futures actually tick up, and then the underlying follows. You see the same thing here. See them start to turn green, and then the underlying just drops. All right, so now let's talk about a couple of multi-day patterns. All right, correlation break. One of the strongest multi-day signals that the VIX can send is a correlation break on a rally. All right. All right, so over multiple days, if SPX is up and VIX is flat, slightly down, is slightly up, that is extremely bearish. We saw this in a year ago, November. All right, so you get the rally and the sell-off. So this is good, right? You're getting a rally, and you're getting vol coming off. Now here, you get a rally, and you see vol doing nothing. What happens? Take a look. All right, now, correlation break 2, and this is what I'm writing about right now. All right, we're seeing a multi-week pattern of VIX not selling off with S&P rallies and reacting harder into S&P sell-offs. It in and of itself is ramping up in ways I've not seen since like 2011. And so do I think that we're in a position for that we're going to have a major sell-off? I'm up in the air. But do I think that the market is conditioned and ready and willing and able to have a real sell-off this time? And the answer is yes. All right, if QE and the Greek exit thing if Europe doesn't do a good QE on Thursday and the Greeks exit, I think we're looking at our first real serious couple of, we could have back-to-back, 40 to 60 point days, down days. And, we could make a real run at a nice 5 to 8 to 10% sell-off. So something worse than October, let's just say that. All right, so here we go again. We've got, the VIX kind of stable on a sell-off, and then you get the rally. Then you get the VIX kind of selling off and stable, and guess what happens? We get a rally out of this. All right, so in summary, use in-the-money options to simulate stock, use calendars and diagonals to simulate a covered call, use the VIX as an indicator. All right, so this was, this is not live anymore, I'm sorry, let me play online training. And I'll tell you, we did this last Saturday, all right? And I wish I could have taught this last week, but so this was really what we did, all right? We did a special Saturday class. It was about, let's see, we started at 8:30 and wrapped up at noon Central. So it was really 3.5 hours with 2 10-minute breaks. So over 3 hours. And we went through really everything stock traders need to know to switch to options, all right? How to make higher profits, risking fewer dollars. We used VIX and volatility as trading indicator. I taught this really cool systematic portfolio trade, all right? And I added a really neat wrinkle that, is just awesome for an IRA, all right? And then I went through some really, how to use debit spreads and credit spreads, calendars for directional trading, butterflies along with single name options. Andrew went through some butterfly stuff as well. So We were selling it at 147 bucks. All right. The replay is yours for just $47. You go to optionpit.com/stocks. All right. You can also see a replay of this webinar there and my using volatility to trade for direction. All of that on one page. And if you use the code CTU100, it'll take that 47 bucks off. If you don't use the code, you're going to pay $147. Still a good value, right? But here, for 47 bucks, 3.5 hours. And honestly, if you take the class and you tell me, Mark, I absolutely hated it. It was the worst thing I've ever taken in my life. I can't believe the time I've lost on that. I will never recover. I will, I shame you and your family. I'll give you your money back, but you won't say that. All right. So anyway, 47 bucks. Go to optionpit.com/stocks. Do we have any questions? A lot of content today, guys. A lot of coverage. All right. I think we're good. Is it a one-time replay or multiple times? You can keep the replay for as long as you need it. And I'll give you the slides too. See the kind of guy I am. All right, if you got questions, feel free to email me, mark@optionpit.com. So it's mark@optionpit.com, or you can call me. Our number is 888-TRADE-01. So feel free to give me a ring. I'm happy to discuss any of this. All right, and I want to thank the CTU team and for everything, and hope that you guys have a great day.